Welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I am Samira Abdi. Now, the difference between our parents' generation and ours has always been huge and on all parameters. But this contrast has never been as stark as it is in today's corporate world, where the rules of the games have changed, the dynamics have entirely changed, and so have the ways in which we deal with them. So, today we're at Olive in Mumbai, and we're here to meet a bunch of young, single, smart and successful career women from the social networking website Ditto, and we're going to find out how they manage to juggle all of this and still manage their money. Hi ladies, thanks so much for being a part of our show and for taking the time out of your busy schedule to be here. We have two fantastic guests with us today. We have Nitin Raheja of AQF Advisors and we have Hemant Rustagi of Wiseinvest Advisors, and we hope that they'll be able to answer all of your questions regarding maximizing your wealth and also protecting it at the same time. But before we start taking in questions, Nitin, I have a small question of my own. You know, when people start investing, the first thing where they get confused is whether they should be doing it on a daily basis or whether they should do it, forget about it, review it on and off. What's the best advice for someone like these ladies? My fervent belief really is that any asset class typically requires a period of time for it to mature, for it to deliver returns. Equities as a vehicle has shown that if you give it time, if it takes 10 years, for example, or even if you take a longer period of 15 years, the average compounded return from equities has been around 14 to 15%. Okay. Now, if you take any large corporate in India, from a Reliance to any other corporate you would name, what was it 10 years ago and what is it today? You will typically see, what we have typically seen in our research is whatever profits grow by, typically market cap, which is a reflection of stock prices, has grown by about 1.4 to 1.5 times the market profits of the company. So clearly, if you are an investor and you are invested in a good company, that does not mean you do not sit and review your portfolio on a time-to-time basis. Currently, especially if you are invested in a lot of mid and small cap, because these are emerging companies, these are emerging managements. They have not yet proven themselves. Against that, you have proven managements who have delivered numbers over extended periods of time. So when you are sitting in them for extended periods of time, there is no problem at all. What is really an issue is that if you get into some of these mid caps and small caps and you don't review your portfolio from time to time, that is a very important thing. Hemant, I want to come and ask you that now that we've established that being in the markets or being in a financial instrument for a long term is one of the keys to investing, how can one go about it? Because I know that compounding also plays a very big role in the long term.
Whenever we talk about a process of investment, general feeling is, it's a very complicated process. So either we don't start the process at all, or if we start, we make it very complicated because we don't plan it. So what is required is that before we begin our investments, we need to plan it. It's very, very important that we establish our goals as to what is that we want to do with this money. Each of these goals will have a time horizon. The time horizon is the period for which you keep your money invested. For example, if you need money, let's say after a year or so, that is your time horizon. For some money you may require after 5 or 6 years, or some money maybe after 15 years. So you need to establish your goals, your time horizon, and also what is the target that you need to achieve each of these goals. What it does for you is it allows you to decide your asset allocation. What mistake that we make is we straight away start buying some stock, some fund, or put some money here and there. That is not the right way. The right way, as I said, is to decide asset allocation. Within that, go for options. If you are comfortable with making selection yourself, or if you are getting good advice, you can buy stocks, you can also invest in mutual funds, or you can have a combination of these two. When you talk about debt side, for example, the obvious choice is fixed deposits, bonds, but that's where we feel more comfortable because we feel that the money is safe. But let's not forget that these are not tax efficient investment options. Every single penny that you earn as interest, you have to pay tax on that. And if you happen to be in the highest income tax bracket, even if you make 10%, 3% you're paying as tax. So what is left is 7%. which means that if the inflation is more than that, your money is not growing at all in terms of value. So there you need to look at tax efficient options like you have mutual funds. Mutual funds are much more tax efficient than these FDs. Gold, for example, if you want to have gold, by all means, I think gold has a place in every portfolio, but have it in the right proportion. So the key factor is follow a process, be very clear what you want to do, and then decide how much money has to go into each asset classes, and then start the process.
Let's open the floor now for questions. I know someone at the back has a question. Go ahead.
Hi, my name is Van Rose Heinemann, and I'm a businesswoman. So this question would go to Mr. Nitin. Right now, do you say that this is the right time right now when the share market is quite low? For people, would you advise people to invest in the share market and say how much, even if you have to invest in shares, what percentage in a portfolio would you invest in shares?
Very clearly, I think, equities is one of the asset classes that you should look as a part of a larger portfolio. So you could have some amount in properties, you could have some amount lying in, gold, you can have, some fixed income, and you can have equities. So you can broadly divide your portfolio. Today, if I were to allocate within a portfolio, given the circumstances today, I would probably have about, at this point of time, about anywhere between 25% to 30% of my portfolio lying in equities. Now, is this a good time to invest? Well, there is never a good or a bad time. Equities as a compounding vehicle has over an extended period of time delivered superior returns, which is a clearly established fact, whether you look at over 10 years or you look at over 15 years. There's some internal work that we had worked on within our organization, and we looked at it. We believe that this is about the time when you should start looking at equities, and I think equities should start delivering better returns compared to what it has done in the last 3 years' time. Why are we saying that? Is because if you look at history, equity markets in India have followed 8-year cycles. So you had a 92 peak cycle, then you had a 2000 peak cycle, then you had 2008 as a peak cycle. Intermittent to these peak cycles, the market always goes and goes over and tests these peaks within a period of 2 to 3 years of these cycles, and then you have phases of consolidation and correction. These are 4-year cycles. 5th, 6th year onwards, the market starts building up a base for going into a new cycle. We are somewhere towards the end of the 4th year and the 5th year beginning, typically. So my belief is, if you believe history and you track history, there is a repetition of this cycle which is possible, and hence you're building out into a new cycle in equities, which will peak by 2016 if you go by history. And you typically, anybody who invests, if you look at history in around this time periods of the end of the 4th year or 5th year beginning, has made anywhere between 100 to 200% kind of returns from equities. So yes, I do believe that this is the time. How do you do it? Well, that's a different question altogether.
All right, so we have another question also. I believe you have a question. Go ahead.
Hi, I've been wondering which one is a more sensible investment. Would it be an SIP versus an FD?
See, we are talking about two different things here. Okay, if your question is whether you should be investing through systematic investment plan in equity or whether you should be doing recurring deposit in FD, then of course it depends on what are you more comfortable with or what is your time horizon. For example, if you are investing for, let's say, next 10 years, you need to ensure that you're investing in an asset class which can give you higher return. At the same time, you can beat inflation. That is what equity can give you. And equity also happens to be, a more tax-efficient investment option. Any capital gain that you make after 1 year is all tax-free. So on the other hand, when you talk about fixed deposit, like I mentioned earlier, even if you are getting interest of 10% and you are paying tax at the rate of 30%, your net return is only 7%. So which means you can't beat inflation. SIP is only a manner in which you invest. And why it is beneficial for you is because equity as an asset class is also volatile. The volatility generally comes in short term and medium term. Over the longer term, it's a proven fact that equities have given better return than other asset classes. And what SIP propagates is a disciplined approach of investing, which means that you're not trying to time the market. You have decided that, okay, on this particular day I'm going to invest so much money into a pre-decided fund, which means that, it helps you in terms of averaging. Over the longer term, in fact, I would say that volatility is not only taken care of, but actually start working in your favor because your average cost comes down and you make more money.
Alright, so I hope that answers your question. We need to take a very quick break at this point in time, but we'll be back in just a bit. Stay with Informed Investor. Welcome back. You're watching Informed Investor. We're at Olive in Mumbai, and we're with a bunch of young, successful women who want to know how they can manage their money better. And there are a lot of questions that are coming in. We have Nitin Raheja and Hemant Rustagi with us answering all of those. So fire away. What's your question?
I have invested in this company called Farmex. I bought these shares around 22,000, worth 12.5 lakhs, and the value has gone to 25,000 now. So to average it also, I bought, another 1 lakh shares last year, thinking that, I'll have a value little lesser. But I don't see anything. It's like going further, maybe 5-10 years I have to wait for, or is just that this is a loss I should consider?
So let me just take one step back. When you invested in the company, what was it that drove you to invest in this company?
See, to be very honest, I invested thinking that the value of the share is very less, and thinking that I'll have number of shares, and when it increase, I'll have a good profit.
I'll tell you, it's not the number of shares that you buy that is important, or whether it's a low value share or high value share that is important. What is really important is what amount of money, that return that you make on that money. That is more important than anything else. Second, and most importantly, I think in a lot of these mid-cap and small-cap shares that I talked to you about, these stocks at times, they're products of bull markets. So typically when there is a bull market, and everything is going up, so even dirt goes up at that point of time. So at that point of time, really there's not too much of research that is going on. Everybody is following a momentum-oriented trend. So if you're doing that, then you need to understand that if it is momentum and there is reverse momentum, I need to stop it also. I cannot allow momentum to carry both ways. Then you make large losses. So it's first and foremost, I think it's very, very important for you know the reason for you to invest is that is the fundamentals of the company good. One of the ways of looking at it is look at the past 5-year track record of the company. Has it been delivering numbers consistently for you to get confidence for you to put in money in that company? The second is if you've invested for momentum, then be very clear that if it has gone against you, then you should clearly have some sort of stop loss target going in it. And be absolutely ruthless and unemotionless about it.
Alright, so I hope that answers your question. Do you have a question?
I think there are certain puppet masters who sort of, are sitting in banks and sitting at Wall Street and sort of the government and the regulators, etc., etc. And does anyone really know what they're doing? So we are sort of lay people, we invest money, we sort of visit blogs and sites and listen to certain people. But you look at what happened in the US market 2 years ago. And finally, what was really scary was 10 people sitting up and saying, we don't know how this happened. They have their suits, they have their MBAs, but they don't seem to know what's going wrong. So then at those sort of times, who do we look at or look to with our hard-earned money? And is it just better to buy gold and store it under your bed?
The fact of the matter is that there are two elements to it. I believe a lot of the problems you're seeing in the world is a failure of politics. And it has really been left to central bankers to hold the baby and manage the baby all by themselves. What is important for central bankers and what they did at that time was to keep the people's faith intact in markets. They had to do a lot of things and decisions which you might agree with, might not agree with. But me as an investor, what do I need to focus and do on? Right? So I need to really focus on a couple of things. What is it that I can track? What is it that I believe is within a limited sense under my control? So which actually comes down to a simple thing. Let me focus on my circle of competence. Right? When you're investing in equities, I think what you need to focus is that, yes, to a certain extent, macro determines long-term bull or long-term bear markets. But you cannot take away the micros, which is where India is today. So, we as a country, if you ever looked at us, except for a short period of time in the mid-2000s, when it was, India shining or buy India, whatever. But if you look at the last 20 years, there was never a big compulsive case for you to invest in India at a macro level. But yet companies in India, entrepreneurs such as y'all, have thrived in such markets based on entrepreneurship. So it's very important for you to focus on the micro. So my point that I'm making is, focus on the company that you're investing in. How is the management is running the business? Because even if the market is bad at that point of time and stock prices are depressed, so great, you're getting a well-managed business at a cheap price. So I think you need to shut a lot of that noise and say, where am I? Ultimately, you're not putting money where the central bankers are putting money. You're putting money in stocks. So you need to focus there.
And I want Hemant to come in on the second part, is that if someone has, their mandate has been violated, where can complaints be addressed, and how should a retail investor like our audience here go about it?
Well, I think there is a very well-established mechanism actually to address all these issues. For example, if it is something related to market mutual funds, you have a regulator called Security and Exchange Board of India, SEBI, you can write to them. In fact, the first thing would be that if it's something related to a mutual fund, for example, you can write to that mutual fund. Every mutual fund is supposed to have a compliance officer who has to, address that issue. If you don't get satisfactory answer, then you can go and approach the regulator. Okay, so I think important thing is also that you must be aware of where you are putting your money and then keep a track. Now, how do you keep yourself aware of what is happening? There is so much information available today. There are portals, there are channels, there are press. You spend some time. We work so hard to earn our money. Why can't we spend even 5% of that time on our money? Invariably, we end up ignoring that part. If you keep yourself aware, you will know exactly whether the portfolio is doing what it's supposed to do, whether the fund where the money is invested or the broker who's advising you on that, whether he's doing his job or not. I think if you're a little alert, some of the problems that you talked about can be addressed at that stage itself.
Right, and I know a lot of your Sundays need to be spent, doing a lot of research before you start investing. But let's take a very quick break on that note. We'll be back in just a bit. On the other side, we'll tell you how a portfolio that's good in theory can still go wrong. Stay with Informed Investor. Welcome back. You're watching Informed Investor. So far, we've been speaking about how to go about making your investments, how to monitor it so that your money can start working for you. We're now going to talk about a portfolio which is good in theory and how it went wrong and how it can therefore be rectified. We get a lot of portfolios on our website, moneycontrol.com. Hemant has been kind enough to select one of them, and he's now going to take us through how that portfolio needs to be reworked. Go ahead.
Sure. We're going to discuss about portfolio of an investor who is 35 years old. He has a total investment around 8.5 lakhs. In his portfolio, he has some mutual funds, some equity funds, one gold fund, and he is invested also in some insurance products, and he also is investing in commodities. So in terms of asset allocation, he is into all the asset classes. He has established his goal of creating a corpus of 60 lakh after 7 years. So he has established his goal, and he has also established his time horizon. So on the face of it, it has all the ingredients that are required to become a successful investor. But when we analyze that, we realize that there are a lot of gaps here. He has said that he wants to create a corpus after 7 years. He has defined himself as long-term investor, but he says my time horizon is 1 to 2 years. So see, there are different statements being made here. There are gaps here. Second is the goals. Even though he established a single goal of creating a corpus of 60 lakh, the goals have to be realistic. If I take his portfolio into consideration of 8.5 lakhs, even if I assume a annualized return of 12%, at best he can create a corpus of 18.5 to 19 lakhs. His target is 60 lakhs. So there's a huge gap. What he needs to do is, if he wants to achieve 60 lakh target, he needs to invest 32,000 rupees per month. That too in an option like equity fund through systematic investment plan. Third is, he has not done enough in terms of risk management. Look, we talked about different goals, different dreams in life. Okay, we work hard to achieve them. But if something unexpected happens, what happens? Those dreams for ourselves, for the family, will remain. How are we going to fulfill them? So it's very important that before anyone starts the investment process, should be adequately insured in terms of life insurance as well as health insurance. In this case, he should have opted for a term plan. A term plan because it's not only cheaper, but also gives you much higher cover. He has opted for unit-linked insurance plan, which is more of an investment insurance product. And he has invested more than 55% of his money in insurance products, which is obviously, when you look at asset allocation, which is not right for him. If I analyze his mutual fund portfolio, he has around 3 funds actually. There again, I think he's gone wrong in selection. One thing which I want to highlight here is your commitment has to be on the asset class, not on the stock or the option. While we say that equity has to be for the long term, you need to keep monitoring your portfolio. Here there are two funds which I think he should make changes. One is Reliance Growth Fund that he has. I believe that if he moves that money into Reliance Equity Opportunity Fund of the same mutual fund, he can get better return. And the second is SBI Magnum Multiplier Plus. As against that, I would recommend a fund like HDFC Equity, where maybe he can get better, because this fund has been doing very well over the last 15 years. So I think these are the changes that he needs to make. And one important thing which I mentioned earlier in the show is that focus on having proper asset allocation, which is what he has not been doing. So I think he needs to really rework a lot on this portfolio to really become a successful investor.
Alright, so I hope that has been of help, and all I can say now is that I hope you're on your way to becoming informed investors and happy investing. Thank you so much for your time and for coming here today. Thanks also Nitin and Hemant for coming here today, and also for taking such an active interest in investor education. So here's where we need to wrap up then. Thanks so much for watching. We'll see you here next weekend, and do remember to keep your questions and comments coming in. Bye-bye.